This is the Value Investor Podcast with Tracey Reineck. All things value, all the time.
Welcome back, value investors. So this is the week we're going to talk about energy again. We've talked about it every 3 to 6 months, it seems, over the last 2 years, because the stocks have retreated from their highs after the Ukraine-Russian war began. And so there have been some deals in the energy sector. We haven't seen oil do what all the oil analysts believe it was going to do, and that's go to around $100 a barrel. It is holding right now in between $70 and $80 a barrel here in June of 2024. Some analysts believe that it will approach, over 80s, in between 80 and 90. This is for WTI, by the way, by late summer. But there's others that are now saying they expect oil to plunge back into the 60s by next year. So just goes to show you, no one knows what's going on in the world of oil and energy. So these stocks are also showing that uncertainty. All of them have sold off of their recent highs, which was in the spring. And a lot of them have pulled back considerably now, where they were cheap before, but they're really cheap now. So it has me wondering once again, is this, are these values or are they traps? And you can't really know for sure on the energies because they are so determinative for at least the producers on the price of oil and natural gas. We can know a little bit better. We have a better idea on the services side, and I'm going to cover one stock on the services side today. And then big oil is kind of a combination of, they have refining. Exxon has the big chemical business. They have gas stations. And so there's all these other factors that kind of play into big oil's earnings. But with just the producers, the pure plays, we do kind of know if crude does go down back into the 60s, those earnings estimates are going to fall again. So they fell. They rose during Ukraine-Russian war because price of crude soared. Then they fell way back last year in 2023, and they seem to have bottomed and were turning up a bit in recent months. But is that like a fake out, or is this truly the trend? We're not really going to know. But I still like the energy stocks, as many of you know, because they are still very cheap. And these companies have been through a lot in the last 4 to 5 years with the pandemic, with oil going negative. They've been through the ringer. They have very good business plans now. They're not overspending on CapEx like we will probably see in a number of years from now, because that's how the cycle works. They are still disciplined. They have good management. A lot of their management's been around a long time, and they've been through these cycles. So I'm liking all of that. And over the last 2 years, they've been really giving cash back to the shareholders, either in the form of share buybacks or dividends, and even special dividends if the price of crude and natural gas gets up there high enough to do the specials. But some of them are still paying out 50 to 60% of free cash flow back to the shareholders. And that might be enough for some of us to stay in these stocks during the down part of the cycle when, everything else is soaring. We have the Mag 7 hitting new highs once again, and then energy is still weak or selling off. It's not great gains on the dividend side of things, but it may be enough to compensate us for our patience for a little while until we see if, crude does go back towards 90, hopefully for investors' sakes, or if it goes the other way, and then these stocks will sell off and get cheaper once again. So if we're looking at whether or not their values are traps, what we have to look at. We've got to look at those earnings estimates and see what's going on with the trajectory of the earnings. Are we still seeing some growth there for this year and next year? And then we'll look at the cheapness side of things too. So let's just dive right into some of the stocks. So I looked at the list of the producers. A lot of consolidation has gone on in this industry recently, and more will probably still to come. So even the biggest in the Permian, Pioneer Natural Resources, has been bought out by Exxon. So they're no longer around for us to talk about. But some of the other big guys still remain, and some of them have been acquiring some smaller companies, and we'll see more of that as we go along as well. But I'm going to talk about two of the bigger cap producers that are still out there. One of the service side, and then the two big oils, because everybody at this point is liking the big oils in addition to the producers. I was never a big fan of the big oils, as I've mentioned before, because there are all those balls in the air, because they have refining and the gas stations and, the chemicals. If you own Exxon, they've got all this other stuff going on. And I just wanted to get the producers. I wanted to get the ones that were drilling it out of the ground. If the price of oil is going up, that's what I want to own, because they're going to give me the free cash flow. But suddenly I find myself owning both Exxon and Chevron now. And it's not because it was not my choice. They bought out companies that I previously owned, smaller energy companies. And so I got the shares in those buyouts. So I now do own both of those big ones, which I've never had happen before. And so I'm sticking around in both of them because Warren Buffett is, right. He's got a huge Chevron position. He's not selling it. And he recently added to his Occidental position once again on this weakness, because we have seen the energy stocks pull back again. So they are on sale. But are they traps? Let's dive right in. Okay, so the first one, we've mentioned it before, is Diamondback Energy, ticker FANG. F as in Frank, A, N as in Nancy, G as in George. It's the original FANG stock. And now it kind of got its name back, right? Since it's now the Mag 7 and we got rid of FANG and FANG Man. But Diamondback Energy, big in the Permian. And what is their market cap? Let me look, because as I said, people keep buying out others. And so they've got a 34 billion market cap. Like I said, they are one of the bigger cap companies. They do pay a dividend right now. Zacks is showing it yielding 1.9%, but some of the dividends can get a little messed up because they may or may not be paying some kind of special, and that may or may not be reflected in this. So we're just going to go with 1.9% right now as the dividend yield, which isn't too bad. Forward PE, 10. So most of these are under 15, almost all of them. And some are under 10, but Diamondback is at 10. And now taking a look at the detailed estimates, because we want to know, is it a trap or an actual value? So analysts are raising estimates over the last week. 2 are higher for 2024. None are lower during that time period, but they're looking for $19.13. That's earnings growth of 6.2% from last year, which was 1801. And then next year, they're seeing further growth, but nobody's raised in the last week over there. But some have raised in the last month, 2 estimates higher in the last month, but 1 estimate is lower for Diamondback in the last week over there for 2025. We're still, 6 months away from knowing anything going on there. So I don't put too much into 2025, but it is seeing another earnings growth of 9.7%. So we're getting, it's going in the right direction now. It does appear that earnings have bottomed for this little mini cycle. But again, if what that analyst believes is going to happen, that's going to go to 60 is true, then these earnings estimates are going to be cut again and it's going to go down again. So we'll see. But right now, this isn't too much of a trap here. This is looking like a value. It's got that 10 PE and earnings expected to be up 6.2%. So that's Diamondback Energy. FANG is a ticker, FANG. Okay, the other one of my favorites is EOG Resources. And they're also big, also Permian US driller, PE of 10. So around the same. They've also pulled back off the recent highs. But let's take a look at those earnings. So expect to make 12.14 this year. That's up from 11.69 last year. So 3.9% earnings growth. That's, reflective of what's going on with oil and natural gas. 2024, however, one is higher in the last week. So some analysts out there is kind of getting more bullish on some of these big oil companies I'm seeing right now, because usually they're taking a look at all the names in their universe, they're making some changes, and suddenly we have, two of these big oil companies, the big producers, with rising earnings estimates in the last week. So that's a good sign. But this looks kind of promising. And 2025, another gain of 4.9% on the earnings side. So it's not declining. It is going up off those lows. Not hugely, but the shares are still cheap at 10 times. So we are getting them cheap enough here. And if these shares only were to pull back even further than what they are, then, we'd really be talking. So I've been a selective buyer this week on some of my own energy companies. I'm not buying any of the ones that I'm going to mention here today. I've not added to those positions, but I did buy one of my others that I owned, one of the other big producers, and I would be a buyer here on any of these in this weakness, or if it, we see further weakness back all the way to those January, February lows of this year, then I would definitely be diving in with a lot more cash. But that's EOG Resources, ticker EOG. Then the service side company I want to talk about is SLB, formerly known as Schlumberger. People don't really want to give up that name, but they are known as SLB now. They do consider themselves to be like a tech company in the oil and energy industries, because they're on the drilling side. They do a lot with technology in the services side. But this stock too is pulled way back off of its spring highs, and it has a PE of just 12.8 now. And I see that it has a PEG ratio of 0.9. So both of those are value indicators right there. But what about those earnings? Well, the service side still looking pretty good. SLB is global. They do a lot of business in the Middle East. That's been doing better than North America on the drilling side. And so that's been giving them a little bit of a boost. But we see $3.51 expected for this year. That's up 17.8% from last year, where it was just $2.98. And then next year, $4.26, which is another 21% gain. And again, it's trading at just 12 times and PEG of 0.9. It pays a dividend as well, now yielding 2.5%. Now that's pulled back off the highs. And actually, I forgot to mention EOG Resources dividend. It's at 3%. That's pretty juicy over there at EOG. And again, not sure about if there's any specials or variables in that number. But SLB at 2.5, that's pretty solid. But I'm really liking this kind of double-digit earnings growth. These stocks on the services side have pretty much been written off. None of the analysts are cutting in the last 30 days for this year or next year. Nobody has raised in the last 30 days either, but nobody's cutting. So the analysts are holding pat right here until this next earnings report, which will be in July. So tune in to the next earnings report in July. But this one, SLB, is dirt cheap. I own it in Zach's value investor portfolio. Okay, then let's turn to big oil. What's going on over there? So let's start with Exxon, which again, I now own because they bought Pioneer. The reason I like Exxon out of the big oils is because of its Guyana position. So it's in the partnership with Hess in Guyana, And that is turning out to be one of the most lucrative places you could be a driller. Everybody is trying to get in there. You can also drill next door in Suriname. Some others are over there, including Total, the French energy company. But Exxon and Hess are in partnership with the Chinese down there in Guyana, and it looks like it's going to pay off big. Now, Chevron, who I'm going to talk about in a second, is trying to buy Hess to get access to Guyana, but they're all in a dispute. It's in the courts. We'll see what happens. But Exxon has the right of first refusal and doesn't want Chevron in there in its partnership. Can't say I'm surprised there. Anyone who knows their history would understand what I'm talking about. So Exxon, that's why I like it. Then they also have the big chemical division. I do like that aspect of their business as well. They're very well diversified. And so let's take a look. PE is just 12 right now. So that's pretty cheap. It is, again, off of its recent all-time highs that it set right as it was acquiring Pioneer, and then it has sold off since then. PEG on this one is 4, so that's not cheap. That's on the more expensive side, but the PE is at 12. So earnings now expected to decline. This is kind of surprised. They just got Pioneer. How are they going to decline? But expected to decline 1.7% to 936 from 952. So I'm not sure what that's about. I'm kind of surprised if that's true. But it says it is. And estimate revisions have been mixed over the last 30 days, one higher, one lower. So nobody with any real conviction there. But we'll see. We'll see how this turns out. That's a little bit of trappiness right there. 2025, they see more of a rebound, 8.83% rebound in the earnings again. Now, Exxon has always been shareholder friendly and they paid their dividend throughout. They are a dividend aristocrat. And right now, because the shares have pulled back, it is yielding a very generous 3.4%. It has been higher. It has been at 4 and 5% when it's been really out of favor on the market. And it has, let's see what it's trading at right now. It's trading at 111 or thereabouts on June 12th, but it's definitely traded at 100 or a little bit below this year. So, keep that in mind. If you're looking at these stocks, we have seen bigger pullbacks than what it's experiencing right now, but still pretty cheap and off of its highs. So that's Exxon, ticker XOM. I own it in Zacks Value Investor and in my own personal portfolio now because both used to own Pioneer Natural Resources. Okay, and then we're going to finish up with Chevron, the other big oil. And Chevron, CVX is the ticker there. C is in Charles, V is in Victor, X is in X-ray. It's trading at 11.6 times. And this one is paying a more generous dividend, and it has for a while, a little bit higher at 4.2% yield. So that's pretty juicy. I'm not going to lie. I'm liking it. It is keeping me, it's rewarding me for my patience, basically. But we'll see how long that patience goes. So far, Buffett has had the patience, and he's being rewarded with that 4.2% yield. Little under what he's able to get for his cash, however. So let's see on those earnings estimates. Is this one a trap too? 2024 expected to be up, but just 2.4%. So a little better than Exxon, not negative. And then next year, 15.6%. So a lot of the analysts much more bullish about 2025 than they are right here in 2024. And remember, there are a lot of things that they're juggling: gasoline, crack spreads with the refineries, and now Chevron trying to acquire Hess, and now dealing with the legal issues there with Exxon. So a lot going on. That's one of the downsides to the big oil, but they also have big further reach in other parts of the world outside of just the United States. And I also like that diversity right now. Now, you could look at a lot of other big oil stocks. I've mentioned some of them in the past, like Total. I like that Total is there in Suriname. Let's just look at theirs to see. Their ticker is TOT. And Isn't it TOT? No, wait, maybe not. It's not giving it to me. I think it's something else now. Oh yes, TTE. Sorry. I think it used to be the other one. Total Energies is what it is, but I always call it Total. I'm not sure how you pronounce it, but I'm going with Total Energies. TTE is the ticker, and PE is just 7.5 because these foreign big oils aren't as followed by American investors. Yield is 3.4%, so pretty nice dividend on this one too. Stock has come off its highs. It's not plunging, but it is off of its highs. And let's take a look at the detailed estimates on this one. Earnings, yes, expected to be down 3.4% this year and then up, but only 1% for next year. So the analyst's not as bullish on this one for next year. And remember, if you're looking at any of these big oils that have global operations, a lot of times, geopolitical concerns can come into play, or even just regulatory concerns in their home countries, but the same is true in America too. So keep that in mind, that there might be something going on where, the company is impacted by things happening in the home country. And so there's a little more risk there, I feel, on some of these companies. I'm not saying that's true of Total Energies in France, but in some of these there may be, especially if you're in, Latin America or something like that, where you might have a little more regulatory oversight. So keep that in mind. That's why some just want to stay domestic and do U.S. drillers, producers, or maybe Canadian producers as well, because things are, little more stable up there, up in the north. But nothing is certain in energy, right? Still got to get it out of the ground, both oil and natural gas. So let me recap the stock tickers I talked about again, and we're going to keep an eye on these. So far, it looks like most of them are not traps, with the exception of Exxon, perhaps. But even that's not too trappy. It was like a 1% decline in earnings. And that can change, in the next couple of weeks. If oil decides to go to 90, then the earnings estimates will be revised higher. So I'm not that concerned about these being traps right here. But like I said, I've been watching pretty closely, and I'm keeping some cash on the sidelines to deploy if these sell off further, which we've seen happen over the last 2 years. So if I can get these cheaper, I will try to get into them cheaper to get higher dividend yields and just to get in there cheaper. But for now, they're still a deal. So the first stock we talked about, Diamondback Energy, ticker FANG, FANG is that ticker. Then we had EOG Resources, ticker EOG. E as in Edward, O as in Olivia, G as in George, EOG. We talked about SLB, formerly known as Schlumberger, ticker SLB. S as in Sam, L as in Larry, B as in boy. Then we had ExxonMobil, ticker X as in X-ray, O as in Olivia, and M as in Mary, XOM. Then we had Chevron, C as in Charles, V as in Victor, X as in X-ray. And then we briefly mentioned Total, which is T as in Tom, T as in Tom, E as in Edward. TTE is that ticker. Don't get it wrong like I just did. TTE is the ticker. And as always, I'm going to be keeping an eye on all of these, as I just mentioned, and we'll see where we go from here in the last 6 months of 2024. But these stocks are cheap. They have good management. They are lean machines right now. So, and costs are under control and contained. So I like the setup here if we were to see energy prices rise even a little bit more. But even at these levels, between $70 and $80, that's kind of the Goldilocks level, because all these companies have very good cash flows between $70 and $80. And that's why you're getting the dividend yields now. And they are shareholder friendly. So, you are being rewarded for your patience. So keep those things in mind. And as always, be sure to subscribe to get all of the Value Investor podcasts, because we're trying to bring you as many value stocks as possible. And even just cheap stocks among the growth stocks. I've talked about that in the past as well. We're going to be getting some more news in the value area when we get certain filings on those, companies like Berkshire Hathaway. And so we'll see where the value investors are putting their money right now. We do know Warren Buffett did just buy some more shares of Occidental. So he's still believing in the energy story here, because the stocks are cheap, they got good free cash flow, and that fits his bill for good value. So keep those things in mind. Be sure to subscribe at Apple, Spotify, Amazon Music, and on YouTube, on the Zacks podcast page on YouTube, and anywhere you can get your podcasts. And I'll see you again next week with some more stocks.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.